Hey everybody, it's Juan Deshon with Quest Trust Company along with Nicole Bako, two of your IRA specialists. Thank you guys for joining today. We're going to allow for a few people to just jump on while we get things started. So with the end of the year comes a lot of questions about a few of our accounts. And one specifically, the solo 401k, is very popular around this time period. Now, myself, along with Nicole Bako, we're usually the individuals that you meet here at Quest and you call us that you'll be talking to about 401k plans. That's why we're both here today. And I want to encourage you guys to ask questions. With StreamYard, we can actually put the questions on the screen as well and show you guys kind of what everyone's asking and answer it live, or Nicole will answer it right there in the chat box. Just to let you guys know also, this will be for playback on YouTube, on our Facebook, etc. So if you can't make the entire presentation or you want to share it, please do. Right. When we get to the 401k plan and the presentation itself, I want to kind of lay out kind of what I'm doing here, what my intention and goal is. And my goal is to be able to kind of show you the bells and whistles of this plan. If you go into a dealership and you're looking for a new car, especially one that's going to be an upgrade from your current one, you want to know what comes with that car, all the bells and whistles. You want to know what it has navigation, things of that nature, right? You want to know what's going on, what you're going to get. So this presentation is very similar. It's going to show you everything the plan comes with and how it functions and kind of basic knowledge on what you need to know. And then hopefully after this presentation, you have a better understanding of what the plan is, how it works, and if this plan is right for you. Right, so I'm going to go ahead and start the presentation. So again, my name is Juan Deshon, the sales supervisor here, one of the IRA specialists, and I just happen to deal with a lot of the solo 401ks here at Quest. A little bit of disclaimer is I cannot give any tax, legal, or investment advice. Everything I'm about to show you is really for educational purposes only. If you are interested in the solo 401k, I highly encourage that you guys check in with your CPAs and make sure this is the right plan for you. And if so, we'll be happy to be your custodian. So for starters, if there's any newbies in the crowd, please let us know how you heard about us. Put it in the chat box. We'd love to see who's new and who's not new. If you're a current client, say hello. But one thing I want to kind of very briefly, I probably have one slide on this, is kind of discuss what a IRA or self-directed IRA is in general. So a common misconception is that it's a very different IRA from the ones that you may find at Charles Schwab, Fidelity, but that's not true. All the IRAs are identical. We all get governed by the same publication, IRS guidelines. It's just a matter of what can you invest it into. An IRA at Quest, for example, is quote unquote self-directed because you can invest it into private transactions, real estate, private entities, notes, things of that nature. Whereas one IRA account at a Fidelity Charles Schwab can invest into public assets, brokerage accounts, etc. Right? So that's kind of the big main difference. It's just what can I throw my money into? But the rules, the tax incentives, how they function, generally speaking, are identical. The benefits for a self-directed IRA and why many individuals are transitioning to this, especially entrepreneurs, is because of the diversification that it gives you. To be able to diversify those funds that you currently have in the stock market to something that you're more familiar with, like real estate, gives you a competitive advantage, right? You can invest into things that you know and things that will give you a better return in the long run. Of course, then we have tax savings, right? Some IRAs give you tax deductions, some IRAs give you tax-free growth, and you may be looking for one or the other, or maybe even both. The other thing is social investing, right? Maybe you want to invest into local investors and you want to put the money to work with a local contractor who's going to go ahead and build a house, right? You want a house, a place for renters, right? Social investing and invest in what you know best. I've already preached it a little bit just now, but basically, if you are a real estate investor, why not apply that same knowledge that you use to put food on your table to also apply to your retirement savings and ideally have a better return in the future, right? So as I promised, there's not too much about IRAs. We're going to dive deep into the solo 401k topic, but just so you're aware, these are the plans that Quest Trust Company administrates. We have them in 3 different categories: personal plans, employer plans, and specialty plans, right? So traditional IRAs, Roth IRAs are probably the most common IRA accounts we see out there. Employer plans like the one we're talking about today, the solo 401k for those individuals who are self-employed, have their own businesses, etc. And then specialty plans for those with children with covered up ESA accounts, or those with high deductible health plans that might want an extra component to it and want an HSA for investment purposes, as well as tax-free, health medical expenses. So If any of that interests you, please let us know. A few more people have joined on, so I want to just again reiterate, please feel free to leave any comments, questions in the comment box. Nicole Bako is also on with me today, and she can help me answer any questions at the end. We'll probably leave some time for it as well. So let us know as we go throughout. We can put actual questions on the screen for everyone to see, and we can address them even live. So if there are any questions, please let us know if anything you guys need. So all of these accounts that we're going to talk about can be self-directed, and the 401k is completely self-directed. But again, don't get that twisted. It just means that you can invest it into private transactions and take more control. And the reason for this vesting that I'm showing you here is because when we talk about the solo 401k, it's a little bit different. So I want to kind of make that distinction. If you're an IRA current holder at Quest, then you may be familiar with this. When you invest through an IRA account, this is the legal name. Quest Trust Company, FBO, John Smith, IRA 12345. It shows Quest as the custodian for the plan. It shows you as the beneficiary of the plan, and this is just the legal name that'll be shown on any contract that you do with the IRA. This is a big distinction because the way that the 401k at Quest functions. When you're doing a research online for where to open up a solo 401k, you're going to find two different types of 401k plans or custodianships, I guess. And one is going to be where the custodian does all the work for you. They're going to kind of manage your 401k plan, give you all the perks of the 401k, but still be the one holding the funds and dispersing it from here to there and be doing the bookkeeping and accounting. Whereas a solo 401k plan at Quest and some other places you'll find are really just what's called plan document providers, or what I like to call them as plan document providers. We will give you the plan to create this entity. A solo 401k is a whole separate entity. It's a trust for you to go and completely control it. All right. So you get a lot of benefits, but the biggest thing is you get a lot of responsibility as well. Because you're the person that completely controls it, and Quest really just says, here's a package of the 401k. This is how you set it up. You go and we help you get your EIN number. We help you set up a checking account at the bank if you're choosing. Well, then now moving forward, all transactions go through you. You never have to pick up the phone and call a custodian again, unless you have some questions. But in general, you don't have to run anything by us anymore. It gives you complete control, and we'll go over that as we kind of just run through the advantages and then the bells and whistles of this plan. So first and foremost, if you're on this and you're kind of wondering, okay, is this a plan for me? I'm not quite sure if I even qualify. Who should have a 401k? First off, we have the self-employed person, right? So first things first, if you're asking yourself, are you self-employed? And your answer is no. Well, unfortunately, you most likely don't qualify for this plan, at least not yet. But if you're planning to become self-employed, then maybe in the future. Company owners that have W-2 wages is an example. Now, this is a key distinction, though, because you cannot have any common law employees. What that means is that you can't hire someone full-time and have them as a W-2 employee and then have a solo 401k. It's in the name, solo. It's got to be just you. Now, the only exception to this is actually a spouse. So spouses, if they're working for the same company and they're working for you, they're actually the IRS refers to them as owner employees. And so they're the only exception that can allow you to contain a solo 401k plan and still have at least one employee because it's that spouse. We'll go over towards the end kind of what happens if you do have employees, but generally speaking, you just want it to be yourself or maybe a spouse. And why you want this is because you get all the benefits of a 401k, a corporate 401k, but it's way more cost effective. So let's dive into the advantages and get right to it. So the first one, a very common one that people seek out, is checkbook control, right? Checkbook control. What is checkbook control? If we define checkbook control, it actually means that you're the trustee of the 401k plan, right? It allows you to establish the account at a local bank of your choosing, deposit the funds, and also invest the funds at your will. You can write the check. Some banks will even give you a debit card for your solo 401k to be able to use. I find this very convenient because clients a lot of times will be doing flips. Well, they can take that debit card as trustee of the 401k plan and go and use it at Home Depot. Now, they can't give a credit card, right? So you can't get any of those kinds of points, unfortunately, because a credit card gives you a line of credit. It's technically a loan, and the loan that's being given to you is not a qualified loan for IRAs or 401k plans. So credit cards wouldn't apply, but a debit card does, as well as checks. I just mentioned that because in this day and age, I don't think most people use debit cards. Everything's paid online, so it's just convenient to know that. So ask your bank if they offer that, if you're looking to establish a solo 401k and also have that checkbook control, right? That's checkbook control. You are trustee, you have access to it. That is why you get it. In an IRA account, you do not get this. Solo 401k, you do. That's one of the biggest reasons why, but it's pretty self-explanatory. Here's an example here. Joe Smith has ABCS Corp that pays him a W-2, has no other employees and a spouse that helps him with the business. So he's the employer. Joe Smith is also the trustee. Joe and his wife are participants in the 401k plan. So here Joe is three different people. He's employer, he's employee, and he's trustee of the 401k plan. It's a lot of power. His wife is another participant, but she's not trustee. So Joe is the one that has exclusive benefits and checkbook control of the 401k plan. And this is part of the article in the trust agreement, Article 1, Section 2, that says that the trustee has checkbook control. So again, Joe has control of it. One trustee is chosen. The wife is participant because that's allowable, but Joe is the one kind of directing those funds and kind of making those investments then moving forward. Pretty self-explanatory there. Number two, and this is where we kind of get to more detail. It might be a little bit more complicated as we move forward. So ability for larger contributions. So if you're an IRA holder, you may know already that your contributions roughly are anywhere from 6,000 to 7,000 if you're over 50 for IRAs and Roths. You might have a larger contribution, if you have an HSA or if you have a SEP IRA plan even. But the 401k allows for large contributions, and it has contributions that come from two sides. So going back to the example of Joe, actually, we'll use him as an example. You can see that he's employer and he's employee, right? He owns ABCS Corp, so that's the employer, right? And then he's also the employee. So Joe has an ability to make a contribution as an employee, but also ABCS Corp, which is him basically, also has an opportunity to make a contribution. That's called profit sharing. So we're going to go into that a little bit. So from there, you can already tell that since you have two sources that are coming together to make a contribution to the plan, it can come up with a larger number a lot quicker. And if you even have your spouse, well, then that same thing happens to them. They have their employee contribution, and the employer can also make a contribution. So even more money in the 401k plan as a whole because you have two participants. So again, we get into the kind of the categories of contributions in a plan and how you can get money into the plan. I'll break them down into four different ways. One is a profit sharing contribution. We'll go into the details of that. One is a traditional 401k contribution. Then we have the Roth 401k contribution, very, very popular and sought out. And then last, we have the rollover contributions. So we'll go over each of these individually, but these are the four different ways that I think that you can get money into a 401k plan and maximize how many funds you have to play with there. Let's take a look at the numbers that we have here. So the employee or the salary deferral contribution. So if I'm an employee working W-2 for my S Corp, well, then I can defer contributions to my 401k plan as a salary deferral. This is very similar to right now I'm doing it with Quest. I defer some payments from my paycheck to go to my Quest 401k as an employee. It's my deferral. That maximum is $19,500. Now, once I reach the age of 50, I get an extra catch-up contribution, similar to IRAs that they have their own at 50, but this is larger, $6,500, right? Giving me a total of $26,000 that I can put into a 401k plan as a deferral from my salary personally. Now, I actually have a comment here, Doug, if you want to put that on the screen, let's show that right here. So Doug says, is it possible to add a Roth component, either Roth IRA or Roth 401k to my current solo 401k? And the answer is yes on half of this. So there is a Roth component that you can add to your 401k, and that's through the salary deferral. There's another way too, we'll get into it in a second, but the main source is a salary deferral. So as an employee, you can decide that instead of taking the funds from my paycheck pre-tax, taxes are taken out, and then I defer a certain dollar amount every, bi-weekly, whatever it is, to my 401k, and that can be Roth. Absolutely. Now, the employer portion, the profit sharing side, it kind of works depending on how much it pays you, how much the employer pays you, and there's a percentage. But this part, unfortunately, cannot be Roth. I'm going to go ahead and hide the comment now. This cannot be Roth. This is going to be a deduction for the business. So it's pre-tax dollars, right? And it goes into the plan. It depends on how your income works. But again, if I'm using the same example as before and I'm a W-2 employee, the employer can get 25% of what it pays me and contribute that to my 401k plan. Now there's a certain threshold limit, and we'll get to that point. It can't exceed $58,000, or I cannot exceed $64,500 if I'm over the age of 50, right? If I've maxed out my personal contributions. There are some maximums, but they're fairly high, right? Now, I'll resurface this question from Doug for a reason. And Doug, the reason why is now that I've theoretically put in some money through a salary deferral, and then I've also put in some money through my employer as a profit sharing, I have Roth and I have pre-tax dollars at this point. The 401k has a ability to do what's called a conversion. If you're familiar with Roth conversions and IRAs, well, you can actually do that within a 401k plan. Now, I highly encourage, if you do that, you get a CPA, and the reason why is because you're basically taxing yourself at this point. There's going to be a 1099-R you have to generate. It's not as simple as 1-2. So you want to get someone involved here to do it properly, but there is a way to essentially move what your employer just gave you into your Roth component of the 401k and make it completely a Roth. So you still have that option. Getting a little sidetracked, but I just had to add that in there. I do have an example of basically how the contributions are calculated in just a moment here. So, and a good thing here is also the Roth 401k. There's no matter how high your income is, you can always make salary deferrals that are Roth. Now, if you have Roth IRAs already, unfortunately, Roth IRAs cannot roll into Roth 401k. They stay Roth IRAs. So let's take a look at the stuff here real quick. So if the profit sharing, let's take the profit sharing first. So basically, this is what the employer puts into my plan, right? So if I decide to take the full $19,500, I'm below the age of 50 as my elective deferral, the type 1 contribution, well, then my employer can give me a profit sharing portion up to 25% of my W-2 or 20% if I'm a Schedule C earner, for example. So the math is really just 25 or 20% of what I make that year. If I'm making $100,000, well, 25% of that of my W-2 is $25,000. This cannot exceed, again, my maximums, which in this situation, under the age of 50 is $58,000. So what that does is if I contribute my full $19,500, what's left that my employer can put in if they reach that maximum is $38,500. That's easier to see in this example here coming up. It should come up here soon, right? When I'm looking at my individual contributions, again, they can be traditional or Roth, as we mentioned, and when we answered Doug's question, I can decide that on a yearly basis if I want to. But what we're doing is we're adding different buckets of money now. Then we have the rollovers. Now, the rollover is any amount of money that I roll over from either a pre-tax traditional IRA account or any other type of employer plan that I've had in the past. If I had an old 401k plan or a TSP, TRS, whatever, 403b, whatever it is, an employer plan with pre-tax dollars, I can roll that into my 401k plan as well. There's no cap on how much that is. SEP IRA is included, for example. So that's another way to get money into the plan. And then each of these 4 different types of contributions, depending on how you decide to track it all, it can be separately, it can be in one big pool. So as I mentioned before, one big thing of checkbook control is you have a checking account. Now, a checking account, as you can see, can be made up of 4 different types of monies: pre-tax contributions, Roth contributions, rollovers, you name it, right? So how do you track all that? I've seen some individuals use sub-accounts, use different checking accounts, and they name it differently. They name one the Roth portion of the funds, they name one the pre-tax portion of the funds, they name one the rollover portion of the funds, whatever it works for them. Then you can use them individually, you can use them in combination as a whole. It really depends on you. That's why at the beginning of this, if you're interested in the 401k, I highly, highly recommend speaking to a CPA or at least having a bookkeeper on speed dial, basically, to be able to see how are you going to track out all of this in the future, right? Because you do not want to mix up the funds incorrectly. You don't want to have improper bookkeeping so that when you come to retirement, you have no idea what's Roth, you have no idea what's pre-tax, what tax yourself on, what is tax-free, and it can be a big mess if you don't do it correctly. This is the example here for this question right here we're putting up there from Madhu. So He asked for the employer contribution. How is the 20% of net earnings calculated? Can you give an example? So this is an example of W-2. So we're going to use the 25%, but same concept applies. So if this individual makes a Roth 401k contribution of 26,000 because they're over the age of 50, so they have the 19.5 plus the 6,500 catch up. They've maxed out their Roth 401k contributions. See that arrow there, yep. Now the profit sharing contribution is dependent on my 40,000 W-2 wages, right? So in this situation, they can only put in $10,000. That's 25% of 40,000. Now, if I ended up paying myself 100,000, well, then I could have actually put 25,000. Right, so this number, that's where it kind of gets from there. So even if 20%, that's if you're a Schedule C earner, 25% if you're W-2. In this example, my total is $36,000 because of these two combined. And this can be Roth, this is pre-tax, right? So this is two buckets of money right here. So this individual, if we're looking at a snapshot of their checking account, we might find that they have one checking account and they've mixed these dollars and they're just keeping track of it elsewhere, or they have two checking accounts and they're keeping track of them by keeping them separate, right? Just depends on what they prefer. So I'm going to move on a little bit on the contributions, but if there are any questions, just feel free to keep adding them. On advantage number 3, it's the ability to give a loan to yourself. So in the IRA account, we get a lot of questions that say, can I do a promissory note with myself? Can I loan myself funds? Or what can I do with this account? I need to borrow some money. Can I take it out for personal use? And you cannot with an IRA, unfortunately, because it's a prohibited transaction. Well, with the 401k, although it's still prohibited to loan yourself money through like a promissory note contract, for example, they do have a loan option. Now it's capped out, but there is a loan option if you absolutely necessarily need the money. So you can actually borrow up to $50,000 or 50% of your account, whichever is lesser of the two. So if I have an account that's worth $50,000, where my maximum borrow limit is $25,000. If my account was $200,000, where my maximum borrow limit is $50,000. Right? You may be looking back, and when COVID started, 2020, it's been so long now, I almost forgot what year it started. In 2020, they rolled out with an ability to up that to $100,000. So there sometimes are IRS notices that change these rules, so keep a lookout for that. But as it stands now for 2021, and that as it's moving forward, I would assume it's still back to the $50,000 being your maximum or 50%. Right? Now, what interest rate or how do you pay this back? Typically, loans are paid back in a 5-year term, amortized. The rate that you have to choose, the IRS language that they use, actually just says reasonable rate, right? So there actually isn't a set rate that they ask you to use. However, reasonable sounds more so like be around prime rate. Don't be giving yourself a loan at the lowest interest known to man. Just give prime rate, maybe add 1 or 2 points. The good thing is that you are paying this back to your 401k, so you're paying it back to yourself anyways. It's not like you're paying someone else, right? There are options for extensions in certain situations. As I mentioned, there are notices that come out when natural disasters happen, and if you need more time, IRS usually, will send those out. For example, here in Houston, one notice came out when Harvey came out that, extended things for 10 years and things of that nature. This is a big one as well. So I would say if I were to rank all of these advantages in a, best to worst, the best one I would say is going to be this one right here, advantage number 4. It has an exemption to UDFI, unrelated debt financed income. Now that's not to be confused with UBIT, unrelated business income tax, or unrelated business taxable income. Those are 2 separate things, but it does have an exemption to one of the taxes. UDFI is what we're going to call it. So what is UDFI? I'm going to go over kind of what it is. Before I do, what is UBIT? For anyone in here that's never heard of the term UBIT, or unrelated business taxable income, what is UBIT? So in order to level the playing field, the IRS has actually added a tax. This has been going on for a while, but they have a tax that IRAs can pay in certain situations. The most easy situation to understand is when you own and run a business. But to give an example, the reason why they want to level the playing field is we take it very basic. We think of a lemonade stand. If you have a lemonade stand inside of your IRA account, and then your competitor also has a lemonade stand right next door outside of their IRA account, and you're not paying any taxes because you're in an IRA account, well, then you can offer your lemonade at a cheaper price. So in order to level the playing field, they're going to say if you are running and operating a business, your IRA is subject to taxation. All that income that it generates is subject to taxation. And the taxation is at a trust rate, which is actually fairly high and parabolic, and how large the percentages jump and increase once you reach income levels of over $13,000. They're already about 37%. So it's a very high tax rate. So for that reason, it's not really a good idea to be running businesses in IRA and 401ks alike. So solo 401k would still pay taxes in that situation. Another reason is renting personal property. So a mobile home is the most prime example of this. If you are renting a mobile home or leasing it out and you don't own the land under it, well, then you're basically leasing personal property. And from there, the IRS says they can tax you. Same situation, you get taxed at a trust rate. Once you reach income levels of over $13,000 a year in the IRA, that would be taxable income taxed at 37% above. So it's fairly high. I wouldn't recommend doing that either. But the biggest thing that is, I think, amazing about the 401k is its exemption to unrelated debt financed income. This is the third level of UBIT, or third reason why it might trigger this taxation. In IRA accounts, they have to pay this. If, to put an example, if I were to buy a property, and let's say that property cost me $100,000, and in my IRA account, I only had $60,000, I can go to a non-recourse lender, let's say North American Savings Bank, and North American Savings Bank will give me a non-recourse loan for $40,000 to purchase this property. Let's say I bought it and sold it in a day. Doesn't even matter how much for. Once I sell it, 60% of my profit would go back to my IRA free and clear. The IRS says, hey, you use $60,000, which is 60% of the purchase price out of your IRA, so 60% of your income is all good. But 40% of it, you use non-IRA money. So we can tax that. So 40% of my income is reportable to the IRS, and the IRA will have to pay taxes. They report, let's just say I made $40,000. They report 40% of that as income, and I'd go ahead and just pay taxes accordingly. With the solo 401k has an exemption to this completely, which is a huge, huge advantage. That means that if you have a solo 401k with $100,000, instead of buying one property with $100,000, you can buy probably two with non-recourse loans, because you don't have to factor in the fact that you may have to pay taxes like an IRA does. So right there, you can diversify your 401k even more using loans to your advantage, non-recourse loans to your advantage, and grow that portfolio with two properties instead of one. This is also a huge advantage for individuals that are interested in investing into syndications. And highly debt leveraged investments like syndications and apartment complexes usually trigger at the end of the whole project, year 4 or 5 usually, they may trigger, I'll say, this taxation as well, because that transaction is highly debt leveraged. With the 401k, a 401k holder won't have to worry about it at all. So a lot of times people are transitioning to solo 401k solely to escape or to avoid having to report any taxable income, as well. What the IRA is reporting it, right? That's the key thing there. It's not you reporting, it's the IRA. So 401k, again, just kind of eliminates this entirely. And I think is the biggest advantage ever that the 401k gives you, along with checkbook control and large contributions. But I think this one right here is number one, and probably the more reason why people want the solo 401k. And advantage number 5, it's fairly cost effective. I kind of spoke about this in the beginning, but the reason why people want a solo 401k and maybe don't set up 401ks for their small businesses is because a 401k for a small business that has employees, I'm talking less than 100 employees, very, very small, maybe talking less than 20 employees, it's very costly. It's very costly. It can, you need someone to be a bookkeeper, you need someone to review your account. It's a lot expensive. But a solo 401k is cheap, relatively speaking, to other 401k plans. At Quest, the fees in front of you are what you see here. $1,500 to buy the plan, and then $495 every 6 years when you restate the plan. What that means is that the IRS requires that your documents get updated every about 6 years because new rules come out, the trust agreement gets updated, and then you guys need to do that too. Now Quest handles that, and we just charge a fee for it. We give it to you on the 6th year. Right now, we're actually going through a restatement cycle where our current 401k holders are going through this process, and it won't happen again until 2027. Now, this is something that doesn't happen when you open your account and then 6 years from then. It happens when the cycle happens. And this is the third cycle. The fourth cycle will be in 2027 no matter what. You can open an account in 2026, and 2027 you'd be forced to restate. Right? So that's a common misconception that it starts when you open it, but that's not true. Just every 6 years from when they started these restatement requirements. Sorry, just reading here a little comment from Doug. So Doug, you're saying that you were unaware that it was possible that you could invest in property with some 401ks and outside funds. Now, what I meant by that is you can invest into, you can use non-recourse loans, right? There's banks out there that will loan to IRAs and 401ks. So you're using outside of IRA money. That's what I meant by when I mentioned your IRA funds and non-IRA funds. Now, Cole, it's a good point. You could also partner accounts, right? You can actually technically buy a property with your IRA or your 401k and yourself personally, but by doing so, I highly just encourage being familiar with prohibited transactions and what you cannot do in that situation. And then we're going to touch on that a little bit, actually. So disadvantages or dangers to the 401k. The first one is legitimizing. So a lot of people get excited for the 401k and really want to set one up, but it might not be the opportune time to do so because they're just getting started with their business. It's just, ground zero right now. And realistically speaking, you don't want to set up a 401k plan before your company or business is profitable and starts, adding value and paying you a salary or paying you something to then it can start profit sharing, right? Key term there. Profit sharing of profit. There's no profit, you might not have a 401k plan. Now I don't think of a 401k plan. I think of it as don't put the cart before the horse. You gotta get the horse first. So the first thing is legitimizing it. Legitimizing is making a contribution. Being able to make a contribution within the first year of your solo 401k establishment is a key component here because it shows that you've created the 401k for its intended purpose. Its intended purpose is to provide benefit to the employee in this situation, yourself. So if you're creating a 401k plan for the purpose of rolling over funds from a pre-existing 401k plan to get an advantage and not have to pay the UDFI tax or to get checkbook control, for example, you're not using it for its intended purpose. You're using it for its many advantages. So the IRS could look at it and be like, why have you never made a contribution? You haven't legitimized the reason why you have this account yet. So we highly recommend at Quest that you just make a contribution. It can be any amount, that there's no threshold, but make a contribution to show that you are actively using the 401k for what it's intended for. Now, you do not need to make a contribution every single year thereafter. Companies can change, you can make profit one year, not the other. So it just depends on your situation. Great question here in the chat. So I'm going to put it on the screen here. When you say employee must make a contribution, does a rollover contribution count, or does it must come from salary? Now, remember, rollover contribution means rollover from a pre-existing plan, an IRA or 401k somewhere else, etc. So that would not count as a legitimate contribution because it's just coming from a pre-existing plan that you had in no job. So what I mean by legitimizing is in a either profit sharing contribution or a salary deferral contribution is kind of what you want to make within the first year or be able to make within the first year. All right. And by the way, publication 560 also has, if you're a nerd like me and want to go read it, publication 560 has minimum funding requirements. Other disadvantages or dangers. I say dangers because it's not necessarily disadvantages, just things you've got to be aware of, right? So one, reporting requirements, right? So the solo 401k has minimal reporting requirements, luckily. And that's actually right here in that blue one in the middle, the 5500 EZ or the 5500, just no EZ, drop the letters. This is annual reporting, right? The 5500 EZ must be reported if your solo 401k reaches a value of $250,000 or above. If you're below that, you actually don't have an annual reporting requirement. If you're over 1 million, then the 5,500 is the tax form that you need to use. So just be aware of that. Have the CPA maybe file that for you. If you're below the 250 threshold and you kind of find it weird that you're not reporting anything annually, it may feel weird, but it's just they don't require it. Now, you will still have to report things like 1099-Rs in situations where you do distributions to yourself, right? You need the funds for whatever reason. You need to do a distribution. A 1099-R is what's used to show the IRS you took a distribution from a qualified plan and you may or may not be taxed on it. In cases of Roth conversion, so earlier when we talked about Roth funds and pre-tax funds in the account, how you can do a Roth conversion within the 401k plan of maybe any profit sharing contributions that your employer has made, you have to then report that. A Roth conversion is reported by distribution, 1099-R, and a 54, actually not a 5498 in the 401k case. So just a 1099-R with a specific code in box 7 that says, hey, I did a Roth conversion. I didn't take the money out myself. I did a Roth conversion, but still tax me on it. Right? And then 990T is going to be the tax form for the 401k when it pays taxes related to UBIT or UDFI. So in the 401k's case, just if you're running a business, for example, and you have to report in the income, it's reported on a 990T. That's kind of like their own W-2. So having this is very important. Keeping careful records of the funds, as I stressed earlier, especially if you're mixing Roth funds and pre-tax funds, is extremely important because they can kind of ruin the total account if you don't do it properly. Right. Other ones are going to be prohibited transactions. So just like IRAs, there are things that you cannot do within a 401k plan. Now, with all these advantages, it's still restricted by publication 4975, meaning you still can't loan funds to yourself. You can't buy, sell, trade, or extend a service with yourself as a primary disqualified person. You cannot also do that with children, parents, grandparents, spouses, right? You're still subject to that 4975 publication and prohibited transactions and who you cannot invest with. You cannot buy a property with your solo 401k and then live in it. You cannot buy a property with your 401k and then rent it to your son, right? There's the things that you want to be aware of what you cannot do so you stay clean. Make transactions with third-party individuals. Understand what you can and cannot do. The second thing is audit triggers. Now, this is hard to say. I mean, honestly, you never know when you're going to get audited. However, the 401k is a space that the IRS can dive into to find mistakes. Being a fairly complicated plan, it wouldn't be out of the ordinary for an IRS agent to audit the solo 401k plan, try to find mistakes to receive tax money, right? So just having clean records, again, I stress it again, because it's in case of audits, you want to have clean records of your transactions. The difference between your transactions personally and your 401k transactions is key, making sure you're never commingling those funds, making sure you're never sending money to your account and vice versa, other than contributions, right? So audit triggers, just make sure you have everything clean. Having some second help is ideal, especially because Quest does not oversee your 401k plan. All right, again, we're plan document providers. We help you set up the 401k plan, give you the documentation, we'll set you off on your way. Those are kind of my biggest disadvantages, I think, or restrictions, or kind of things you want to be on lookout for. Restrictions on IRAs and 401ks alike. Understand people restrictions, investment restrictions, and transaction restrictions. People are the people I mentioned: yourself, spouse, kids, parents. Right? You can't transact with them. Investment restrictions: you cannot invest into collectibles or life insurance policies. Collectibles are like art, for example. You may be on here, maybe thinking crypto spaces. Technically, you can invest in crypto. They haven't ruled that out. So crypto would be allowable in a 401k. I showed you the vesting for an IRA earlier, right? The IRA was Quest Trust Company FBO for the benefit of. In this case, it's a little different. It's your 401k plan's name. An example of Jones Consulting 401k plan. Bob Jones is the trustee, and it mentions that in the name. Right, so a little bit different name. This is the legal name. And again, you have your own EIN number. What happens in the case that you get employees in the future, right? If you get employees in the future, you can still have a 401k. You just have to upgrade it. Basically, the plan has to be a little bit more advanced than it is already. We don't provide this plan, unfortunately, because it involves a lot more people, and actuaries have to help you with testing requirements to make sure it's not top heavy. So this is very important that if you plan to set up a plan for employees and you want it to be self-directed, kind of shop out there, make sure that they understand your main goal, what your investment strategies are. It has been done. To give you a little insider information, Quest's company 401k plan, the one I'm part of and all the employees are part of, is completely self-directed. So it's possible. It's just a little bit more expensive, a lot more expensive, I'd say, and a lot more people will be involved than just yourself. All right, so let's recap a little bit. You have checkbook control. You have higher contribution limits, including the Roth 401k contribution portion. Loans to yourself, exemption to UDFI, unrelated debt financed income, not UBIT. Inability to roll over traditional IRAs or SEP IRAs or 401ks over from past employers to your 401k plan, as long as you're self-employed, have no common law employees other than your spouse. Well, these are the investment choices that you have, right? Real estate, private entities, promissory notes, but actually you have much, much more. So part of the solo 401k, because you have checkbook control, you have freedom outside of what your custodian allows you. In the beginning, I mentioned the self-directed IRA. It's only different because of the custodian and what they allow you to invest into. With a 401k, you kind of become that custodian. So as long as you allow it to invest into real estate and invest into maybe stocks, it's possible. For example, I've seen clients of mine use their solo 401k to invest into real estate or private transactions, and then also take some of their funds from the checking account and set up a brokerage account under the EIN of the solo 401k out of Charles Schwab or Fidelity or E-Trade even. This is the same kind of concept if you're a crypto investor and you want to do the same thing with crypto. There are some platforms out there that will create a wallet basically for entities. So you can actually branch out and do a lot more within this just one plan because you're not restricted to custodians. And that kind of lessens the fact that you have to move money back and forth, etc. Right, so the investment choices are a lot more broad. We had a question a little earlier, and I think Nicole answered it, but does the $1,500 include management fees? Now, remember, we do not manage the plan. Now, we'll never turn away a phone call. You give me a call and you have a question, I'll answer the phone. I'm going to give you the answer as best as I can, or give you resources to help you out. But unfortunately, we do not manage it. We don't administrate it the same way we do IRAs, where we have a client portal, we take care of the funds going in and out, we disperse the funds. Part of it is the control you get with the 401k, right? With great control or great power comes great responsibility, right? Spider-Man, right? So you basically have complete control there. Because we're at the end of the year, as I'm wrapping up a little bit, I want to go over deadlines. If you are interested in the plan, then I'll let Nicole Baco take it from there and kind of give you some things of what's happening with Quest at the moment before we head off. Is deadlines December 31st to establish a 401k for the year of 2021 is that deadline, right? What that means is basically you have to sign your adoption agreement. All your 401k paperwork have to be signed by December 31st to be able to qualify to make contributions for that year. So if you're a self-employed individual that doesn't necessarily know how much you make until tax filing deadline plus your extensions, well, then you might want to set up a plan now to then figure it out later on and then contribute for 2021 in 2022. I hope that made sense. That's December 31st. The other thing I want to mention is your last day to set up an EIN number. The IRS website last year closed down the EIN website for maintenance on December 30th, and it didn't open up until January 4th. I suspect they're probably going to do that again. I think they do it every single year. So the reason why you would need an EIN number is not necessarily to set up the account by December 31st, but to set up a checking account. So if you're trying to set one up to immediately invest and have the funds in a checking account, you might want to do that before December 31st, even so just a little bit earlier, or as early as possible, because you never know. Maybe they'll do it earlier this year than last year. So that's just a little bit of information that I've gathered based off of what happened last time. All right. And basically, this is our information, right? So if you want to contact us or have any additional questions, use irspecialist@questtrust.com. Nicole, I'll invite you over to show your screen a little bit and talk a little about what you got going on right now. One thing I will mention too is we have a specific solo 401k email. I'll put it here in the chat box, solok@questtrust.com. It's very useful if you want to have a consultation specific about solo 401k well, then just use that email. There's specific individuals involved there that will be able to answer all of your questions. Doug, real quick before I let Nicole speak, Doug, how to contribute in 2022 for 2021? Great question. So basically, you have until, if you're a individual that's a Schedule C earner and you filed for extensions, you have until your tax filing deadline plus your extensions, that could be April 15th or October 15th, to contribute for the previous year. Tax years work a little bit differently. So the tax year technically of 2021 can still go on in 2022. That's why you still have time. I can explain that a little bit more or better if you want over a phone call, whatever you need. But that's essentially the gist of it. If you are a W-2 employee of your company to contribute to 2021, you basically have until your last 2021 paycheck. So if that's the last week of December or maybe the first week of January, depends on what your situation is. Keep that in mind. Any details, again, I encourage asking your CPA, whoever helps you out with your self-employment income. Nicole, you want to take it away?
Sure. Thanks so much, Juan. Well, it was so much helpful information on the solo 401k. I'm also on the solo 401k, so any more questions that come in, I'm happy to help answer those. I'm so glad Juan left up our contact information. I have a few slides to share myself. Let's see if it'll let us do both. All right. Slideshow. There we go, from beginning. Okay, so we do have a lot of education. I know that question was brought up about, the managing. We don't help manage the solo 401k, but we certainly have tons of resources to help you. Of course, you could always call us, email us. We are happy to help, but we do have a lot of resources to help you. Of course, we do have these weekly classes. We have classes on Saturday as well. Our YouTube channel really is full of tons of information. We could keep you busy for months. We even have a certain playlist that's all about the solo 401k. I'm sure in that videos section of our YouTube channel, there's even more information about the solo 401k on other webinars we've done. And of course, on all things self-directed, as far as other investments that you can do or other strategies that other people have used. So we are just a wealth of free education out there. So please use that as a resource. Our website as well has tons and tons of articles and blogs and videos. So we really are here for education. You don't have to be a client. You can call us, email us. We really are here to help you. So some other announcements that I kind of wanted to make. If you are in the Texas area, Houston, Austin, or Dallas, we are starting to have our in-person events back, which I know we're all excited about. So the first Tuesday, I apologize, these have dates on them, but the first Tuesday of the month is going to be our Houston in-person social. We are still having them for the month of December, and of course, they're Christmas themed. The second Tuesday of the month is going to be in our Austin office, and the third Tuesday of the month is going to be in our Dallas office. So make sure you sign up for those. We're really loving to have our in-person people back. Come network. There's other vendors there, and of course some education, and it's catered. We'd love to have, come have a drink with us and some snacks. This is another way that you can meet other like-minded investors. We have a virtual networking happy hour for those of you not in our Texas area. I actually host a lot of these. I think it's really, really fun. I make it really exciting. Come have a, glass of wine or beer or drink of your choice with us. We're actually having the second one of this month tomorrow night, 6:30 Central. We would love to have you. If you're brand new to this, you can say, I'm brand new to this. You don't have to come on camera if you don't want to, but you can kind of hear how other people are, doing things in their self-directed IRA, what assets, they're investing in or how they're doing it. This would be a great place to come learn, and we'd love to have you, Quest client or not. All are welcome, honestly. So we'd love to see you there. And of course, we are opening Roth accounts for free through the end of the week. I know this says 12/10, but it was such a good opportunity. I know Juan was talking about those Roth conversions. So now you can do that with a new Roth account for free. So contact us. We'd love to tell you how to do this. We have a discount code for you. waiving the account opening fee. We'd love to help you. We're having that holiday sale, so make sure you get in touch with us, and we'd love to help you out. And of course, how do you get in touch with us? Well, I'm so glad you asked. We'd love to tell you more. So you can go on our website. We have a live chat. It is not robots. I get that question a lot. It is actually us, the IRA specialist and the transaction specialist. Or give us a call. I love our phone number. We really do think this is fun. We really find this exciting. 855-FUN-IRAs, or email us. Oh, gracious Juan, I forgot to put yours on there, but I will put it in the chat box again. Nicole.baco@questrust.com is how you can meet me specifically. Let me get out of this and remove this, and let me put Juan Deshon at questrust.com. I should have gotten my glasses. All right. Now I have Juan's number in our chat box. A few other reminders, just to let y'all know kind of our holiday hours. We are closed on Christmas Eve, and on the 23rd, we will close at noon. We are open New Year's Eve, which is the last day you can do a Roth conversion. So we're happy to help you then. We will be here all day. So half day on the 23rd, close the 24th. We are open all day on New Year's Eve to make sure you can get those end of year dates met, and we're here to help. So I'm looking in the chat. I don't see any more comments or questions. We have some time if anybody has any. I don't see any on YouTube either. All right, guys. Well, if there's no more questions or anything for me, I loved being here for the webinar today. Happy to help in any way we can. We put our contact information there. So everybody have a wonderful rest of your day, and thank you so much for joining another weekly webinar with Quest Trust Company. Have a wonderful afternoon, everybody, and we will see you next time. Have a wonderful day, everybody. Bye, guys.